Hi and welcome to this episode of ICMA Education and Training presents Let's Talk Markets. And I'm here to do this with Anjuli from HSBC and Ketish, recently retired from PIMCO, but still very active in the market on various boards. So very happy to talk with both of you. And Anjuli, you're obviously the head of Sustainable Debt Capital Markets, so you're really still in the thick of it and can tell us about the markets. But let's talk about how ICMA looks at transition finance, and maybe Anjuli, you can tell us a little bit more about how we do this.
Yeah, so I think on the XCOM, where we're supporting the rest of ICMA to put together the principles, we try to look at transition finance as something a bit holistic that can feed into the principles that already exist. So definitely, investing in certain green activities is a core part of the transition, right, which falls under the green bond principles. We also have the sustainable linked bond principles. The sustainable linked bond principles obviously allow you to attach KPIs and sustainability performance targets that often tend to link in the market towards GHG emissions targets or other kinds of transition targets that a company might set, and increasingly that sovereigns also are using this product to set. And then we also have the Climate Transition Finance Handbook. Now that's quite frankly sort of a gold standard. I wish we had every kind of data set that we needed to explain transition, but it does allow issuers in the market and investors to have some kind of a benchmark to refer to understand what kind of data sets really help to inform on a transition pathway of a company or a bank or a government or anyone who wants to sort of explain their own transition strategy.
Yeah, so transition as a theme under the principles that we can finance through a green bond, for example, also a sustainability bond, which is a mix of green and social, but also sustainability linked bonds, which are general purpose instruments. Mm-hmm. And they have kind of emerged as a transition instrument, haven't they? Let me turn to you, Ketish, because you were actually involved in creating the first principles in 2020, and we have since updated them last year. But tell us a bit why we did that back then, and also how do you see the development and the take-up in the market since then?
So the idea of sustainability-linked bonds was to complement the existing green bond market and the growing interest in the green bond markets as well. And what it was at the outset was to give companies an ability to publicly announce targets which they wished to achieve. And those would be actual material changes in behavior. Those targets had to be material changes in behavior. For example, if you're a utility and you want to transition your source of generative capacity away from non-renewables towards renewables, and you said, this is my percentage change, then you had to commit to that, and also it was an incremental change, so it was no longer business as usual, and it was going to make significant changes in behavior. And if you could take a step forward from that, then that gives you public scrutiny of your behavior as well. Your name is on the product as a corporate and as a sovereign as well. And the idea of transition sits very comfortably with sustainability. Because if you think that, say, what is sustainability? It's effectively transitioning away from go as you please behavior at corporate and sovereign level to behavior which means that, say, the world that we pass on to generations coming is a better one from a sustainability perspective, and that's transition. So that's why sustainability-linked bonds effectively gave, not every company or corporate or country has got shovel-ready green projects which they need to finance. But at the same time, they also want to demonstrate their commitment to change. And that's why SLBs came into being.
And also to be held accountable.
Exactly.
Right? So you have to provide that commitment to the market, and then you're asking the market to start to evaluate your risk profile with that commitment in mind and your ability to manage the various climate risks or a broader sustainability risks that you're committing to. And you're actually kind of triggering the market to use that data to think about valuation in terms of credit fundamentals and ultimately, quite frankly, pricing, because your coupon there would be a financial mechanism in that instrument that links to the performance against your KPIs and targets.
Yeah, that's right. And also quite interesting, Ketish, that you mentioned transition overall. You didn't specifically talk about, as I think it's mostly understood in the market, transition being climate transition or energy transition. Transition can be much wider understood, where we also see SLBs with, for example, KPIs for nature and biodiversity. We saw a lot of those in Brazil, for example. We also have social KPIs where, for example, the number of women on the boards would be increased. So that's very important to also clarify that it can be a wider instrument. However, as you will know, in the market, most KPIs are on greenhouse gas emission reduction, for example, yes, to underline a transition strategy.
Which is not entirely surprising if one looks at, say, what is the most pressing challenge which sits in front of corporates and in front of governments is the environment. That doesn't mean to say in any way that you downgrade the importance of social KPIs, but if you look at, say, the majority of the KPI registry, which was an active debate between issuers, investors and arrangers, debt arrangers, to actually come up with a registry which was so comprehensive but not complete that it was going to be regularly reviewed. And that's been demonstrated by ICMA's and the ExCom's work last June, where they added to the principles and gave greater clarity, especially from a sovereign level, on issuance. So it's the whole point of this is that transition, sustainability-linked, sustainability finance is dynamic, it's constantly reviewed. Challenges are in front of us as well as present. And as a result of it, it can't be a static environment in which corporates are asked to exist in.
Yeah, that's true. And we updated the principles last year, indeed, following what we've seen from Chile and Uruguay, were the first sovereigns to issue SLBs as well. But you just mentioned the KPI registry, which was indeed created back then and will continue to expand on that, which gives an extensive list of KPIs, non-exhaustive, of course. But Anjuli, in your daily work with corporates as an underwriter, how do you see them approaching the topics of SLBs or maybe in general financing the transition? What kind of questions do they have, and is it an issue for them to determine is the KPI material and also targets, are they ambitious enough?
So I think when a corporate is thinking about their transition journey, they're thinking about it in different ways. One, definitely, they're trying to look at the data, understanding what falls within their scope 1, within their scope 2, what falls within their scope 3, the various categories within that, where could they have slightly more action or influence, maybe through advocacy or through putting their own kind of pressure on their supply chain or working with their clients on the end use of their products, things like that. So one is the actual data, knowing the scope of their influence, if you will, and then understanding where they can take responsibility and try to track that data. And then, of course, disclose that to the market. The other area is really fundamentally questioning, what is the service or the product that they provide to society, and how does that need to evolve in order to create a net zero world, right? And so for some sectors, there's a very clear pathway. There's certain technologies that have been proven. A lot of utility companies, for example, understand that there is a movement that they can make from natural gas or coal towards renewables. And that's the kind of targets they're putting out. They're saying, okay, this is the percentage of my business that's moving towards renewables and it will increase. I think Enel is a very credible issuer who's done those kinds of targets in the market. For example, many other utility companies have used green bonds, sustainable linked bonds to demonstrate that commitment to the market. But there's also a lot of sectors where it's almost like a black hole between 2035 and 2050. We don't know what is that technology going to look like. Quite frankly, we don't know what the purpose of that sector might even be. More traditional energy sources, will that exist in 2050? Of course, we know when we look at International Energy Agency scenarios and other scenarios, that we need all kinds of energy in 2050, but at varying levels. So, they're trying to ask themselves, what is that CapEx, that investment, that technology that I need to be investing in and supporting, either through my own business or through sort of mergers or acquiring, information or data or working with innovators around the world to figure out what my transition journey looks like. And those types of, what we call the harder to abate sectors, where there's a lot more complexity to thinking about their transition, those types of sectors are probably, understandably less focused on what the target is right now and the KPI, although, they try their best to be as transparent. They're much more focused on understanding their business model, working with governments, working with, international organizations, to some extent working with nonprofits as well, to figure out collectively how do we try to resolve, because they often tend to bring some of the most important things to society, whether that be steel, cement, mining, energy that we require.
And that sort of segues very nicely into this idea of the just transition as well. So, and where legislation plays a part and also where politics plays a part as well. And to an extent, this is where, say, the educational background that, say, ICMA gives to market participants comes into play. Because every year you've got another 10 alphabet soup acronyms to deal with. And if you're not up to date from an educational perspective, then you're going to struggle. Because the world is moving fast from a regulatory perspective, layers and layers of complexity are added and you have to stay current. But if one thinks about, say, just transition versus, let's say, legislation and regulation, is that if you have pure focus on sustainability, but not focusing on the social impacts of that sustainability, then you have pushback on your ultimate goal, which is sustainability. And so you have to Anjali's point, is that it needs to be a collaborative approach by regulators, by corporates, by consumers, and to get buy-in, but also not to cause societal damage. And I think the European Union has got, as of this year, has got a fund which is dynamic about helping the transition to net zero whilst aiding those companies not to impact at a social level as well, where loss of employment, for example. And if you look at, say, the success of the Inflation Reduction Act, the IRA in the US, one of the reasons why it has been successful is that it brought in government money at the same time as bringing in private money, and to allay some of the concerns that, for example, in the Rust Belt states, that say they have been left behind, is that a lot of production is shifting for US sustainability to areas where there are poor economic outcomes right now.
Yeah, thank you for mentioning that. And also thank you for mentioning ICMA education, because indeed, I think you also mentioned that corporates sometimes don't really know what's going to happen, and maybe they also need help understanding how the market works, how the guidance works, how the principles work, and so on. So that's where education comes in, and we are obviously involved in that and work a lot with the market on that. But also on just transition, the social side is indeed becoming more and more important, because as you've mentioned in the policies, sometimes, or in the beginning at least, this wasn't maybe considered or thought through. So we have seen a lot of unrest, for example, such as the Gilets jaunes and so on. And it is something that's increasingly talked about, not just as in transition and just transition, but sometimes we're now hearing that a transition can't be done without being just and fair. So there's really only this term, just transition.
Yeah.
Right?
And I look at, say, the political environment. It's very difficult to talk about this completely neutrally, but at the same time, it's clear that we have a problem with the environment and we need to change our behavior. But one has to be honest about the costs associated with that. You can't just say we've all got to change and that's it. If that means wholesale unemployment in large sectors of the workforce, then that's not really going to get buy-in from the workforce. So you have to balance. It's always about balance.
And I think this is one of the challenges for us at ICMA, right? Because we are a global platform. And I think that's where the principles are trying to provide, governance processes around reporting and transparency, because there's two facets to sustainable finance. There's the concept about disclosure, right? That the more we have data, the more we can make decisions, the more we can understand the challenges and the opportunities that a sector, that an issuer, that a region is going through. And then that data itself is so valuable. And then there's the second part, which is about ambition, which is, okay, now you have the data, how are you using that data to set yourself certain ambitions? And we have to keep reminding ourselves at ICMA, when we're thinking about, adaptations to the principles or the Q&A, how would this work in an emerging economy? How would this work in a country that is heavily still dependent on coal and still has a chunk of its population living off-grid without access to electricity? How do we make sure that we still are pushing for ambition and we are addressing this very serious requirement, which is, the climate crisis and all the other different social crises that come around it, or environmental crises that come around it. But at the same time, in this period today where we do not have all the technological solutions at a financial, affordable scalability, how are we respecting the process of disclosure and data to use that information to then help persuade and move the market and move capital flows towards the areas that need it most, right? And so that often tends to be, when you think about transition, there's a lot of that falls out of the officially green scope, right? Which is crucial to getting those types of countries or sectors or regions up to a place where eventually they are fully in the green scope.
Yeah, very true. And also that's why we, for example, have a body called the Advisory Council, where we focus more on emerging markets, because indeed when we talk to different jurisdictions and different regions, we hear about the difficulties, and transition is not approached in the same way maybe everywhere. Not everyone has the same starting point, not the same pathways and so on. But you also, in the beginning, you mentioned the Climate Transition Finance Handbook, the CTFH as we refer to it, which should be used in conjunction with any instrument, really, if you want to finance a transition. Can you maybe explain a little bit more about, maybe Ketish, you could make a start, what is the Climate Transition Finance Handbook really doing, and why have we produced this guidance, and also how are we linking other guidance that is out there into that?
So I think the way Climate Transition Handbook came, as Transition Finance Handbook came into existence, was to offer a holistic overview of what it was that companies needed to achieve, or corporates, not just companies but also governments as well, and it to set the scene effectively at a grand level, and then to become more and more specific as it became more granular. And it was always being reviewed, and there's a full working group within the principles which continues to work on the handbook itself. And it then sits very comfortably with the other principles which have been brought into place, the green bond principles, sustainability-linked bond principles, and the guidelines for sustainability bonds as well. And if you think that, say, the layering of guidance, bear in mind that this is guidance, and it is adopted globally, because I think ICMA's work is so leading in this field of sustainability finance, is that people tend to use this as the benchmark within which to base their own judgments. Now, that might be sort of talking too grandly about how good ICMA is, but it's fact. This has been the basis, and the largest body of work has tended to come from ICMA with regard to the guidance for corporates and governments with regard to sustainability. And I see that the Transition Finance Handbook sitting very comfortably at the top of that template. It's effectively, if it's like a tombstone, they're the large name at the top, or that is the large name at the top. But there's another point to this as well, and Anjuli touched on it very well, is this idea of reporting standards and within sustainability. And if you think that, say, one of the biggest challenges right now is to get global buy-in to reporting standards, and you've seen this in accountancy itself, it took a long, long while for GAP to be accepted globally, and there are local nuances. But the progress that has been made in the past 24 months to achieve these standards is quite notable. But again, it is partly based on what the Transition Finance Handbook has started out with.
Yeah, and it already incorporates a lot of other approaches there. We have the sustainability or registry as well, registry of methodologies that are out there. For example, bringing in the UK Transition Plan Task Force, the UK, the TPI as well, Transition Pathway Initiative, but also guidance from the OECD, Science-Based Target Initiative, and so on. Also taxonomies, both market-based and the ones developed by such as in the EU official sectors. So it really incorporates all of that already, and ICMA also recently published a paper connecting all those dots with the Climate Transition Finance Handbook. So that's really important to say as well. There's so many developments. But just maybe to conclude, or not to conclude, but just one final thing. Maybe we talked a lot about corporates, we mentioned sovereigns as well. Anjuli, what is the market expecting from banks when it comes to the transition? Because they obviously playing a very important role, not just as underwriters, but also lending money to the economy.
Yeah, no, and I think the principles are really keeping in mind all asset classes. And as a financial institution, whether that be an insurance company, a bank, even private equity, understanding the role that you have in terms of moving capital, and moving capital in two ways. One, towards the solutions or towards those that require the capital to then implement into solutions. And also to some extent what's been really popular, I would say even more in Europe, but definitely across the world, is thinking a little bit about how you move capital away from areas that you think are perpetuating the problem or are not really serving in the best interests of a more sustainable future. And that's quite a complex thing to balance, right? And I think the market is now increasingly expecting financial institutions to be able to explain in very clear terms, how do they manage that balance, right? And I don't think that there's an expectation of, what we call kind of wider spread sort of divestment or anything like that, because there's a real strong call as well for engagement and managing how to deal with stranded assets, with sectors that need to transition the most, who actually, quite frankly, need the most support and often tend to be the sectors, again, going back to the hard to abate sectors like aviation, transport, cement, steel, energy, which we all rely on, very crucially as society. So banks are trying to figure out, how do they message their strategy? How do they have a good balance between engagement, supporting those sectors to transition, but also take some accountability and responsibility of moving capital and trying to make areas of the market that are more innovative, more bankable is what we say. Some of these technologies that are slightly more riskier, but we know if we get them right and we're able to scale them, they have fundamental opportunity that they can provide to the transition, right? And I think at the moment, banks are at the very core and center, quite frankly, of this broader ecosystem that's happening in the transition, because ultimately, it's going to take a lot of capital, and it's going to take a lot of fundamental shifts in how we think about credit valuation, how we think about financial performance with non-financial risk, for us to be able to make sure that we are incentivizing that capital to be moved in that direction.
And it's not passive. This is the thing, right? It's active. And if you look at, say, hard to abate sectors, if you abandon them, effectively say, right, we're not going to give you finance, they will find finance, and that finance will be less accountable. And so the point of, Anjuli's point about engagement is absolutely spot on. Yeah. The reason why you engage rather than divest is that you might actually install change.
Yeah, and you could argue the SLBs are a bit of an engagement tool.
Precisely, and that was the beauty of them, was it effectively a public declaration of change, which had to be material and also annually reported on.
Yeah. Sorry, I'll go one step further. I think everything that ICMA has come out with is an engagement tool.
Exactly.
That is the purpose of what ICMA is trying to provide. Yeah. How do we create engagement that has good governance and transparency behind it so that you can make informed decisions as market participants?
Yeah.
That's a beautiful note to end on. We could discuss for hours, I think, especially on transition finance, which we're going to hear a lot more about this year. I think especially since we hear quite often now the real world almost clashes what we envisaged perhaps last year or 2 years ago.
We didn't want to do transition finance.
And we didn't know about the energy security
we
being
were
an
scared.
issue.
I think people were scared to talk about it, right? And
Yes.
people, the more we have data and information, and the more that we feel confident with the quality of data as we all collectively work to evaluate and verify that data, the more confidence we will have as a market to look at transition finance.
Yeah, but it's really an important area, and it's an area where the real world and the politics and social issues and everything come together, energy security. And
A good note to end on is that you shouldn't sacrifice progress at the altar of perfection.
That is very true. All right. Thank you very much, Anjuli. Thank you very much, Ketish. Always a pleasure to talk to you, and thank you.
For having us.
Thanks for having us. Yeah.